morning everyone and welcome to the final MFP Outcome Matters webinar for 2025. I'm Therese Grobler, Head of Wealth Management at MFP, and it's really an amazing day to share with you as we wrap up another dynamic year of insights, collaboration and shared growth. MFP Outcome Matters was created to do exactly what the name suggests, to focus on the factors that truly shape client outcomes. Each quarter, we bring you market insights, fund updates, and perspectives from leading experts to help you navigate a world that really never stands still. Our theme today, Growth Opportunities Amid Global Uncertainty, couldn't be more relevant as we close out the year. Despite the noise and volatility, opportunity is still everywhere. The difference lies in how we interpret it, how we position for it, and ultimately how we guide clients through it with confidence and purpose. Before we start, a quick housekeeping reminder. We have applied for CPD accreditation for today's event. So to ensure your attendance is properly verified, please watch the full session and submit your ID number under the CPD section. The platform will remain open until the end of November 2025, giving you ample time to revisit the content and earn your CPD points. These certificates will also be issued automatically once all requirements have been met. And as always, please use the Q&A function to post your questions. Our presenters will respond either during the session or shortly afterwards. We really have a fantastic lineup today with topics that bring our theme, Growth Opportunities Amid Global Uncertainty, to life. We'll kick off with Sanisha Bakarasamy and Chiamo Masike in Growth Gambits in Geopolitical Gals, where they'll unpack the latest global and local economic themes and what these themes might mean for portfolio positioning in 2026. Then Nkosana Nzima will take us through Curate Turns 1, a look at how simplifying complexity helps advisors deliver consistent outcomes for clients. Next up, Flobela Yates will share why DFMs are becoming the smart choice, exploring how discretionary fund management is helping advisors build more consistent, scalable, and defendable investment strategies. We'll then hear from Rupert Gissing, who'll give an update on the MFP multi-managed solutions, sharing insights into the recent performance, the positioning, and really what's shaping returns across our range. After that, Janine van Heerden will explain why we call it a personal share portfolio, unpacking what makes this approach so unique for clients who want greater flexibility and ownership. And finally, we'll close with Richard Stutley, who'll give us a global perspective in Trump versus the Fed, implications for global portfolios. A timely look at how US politics and monetary policy could influence markets in the year ahead. Before I hand over to our first speaker, I want to pause for a moment to touch on a few key developments from our wealth management team, especially for those who weren't able to join us at the recent Business Connect sessions. In those sessions, I spoke about how our MFP Wealth Solutions framework continues to evolve. And it's not just in terms of product and performance, but also in how it strengthens your value proposition as advisors. These enhancements were made with one clear goal: to give you more flexibility and relevance to solve for every client need. Over the past year, we've listened closely to advisor feedback and kept a keen eye on market trends. As a result, I'm thrilled to share the latest additions to the MFP flagship fund range. As you will see from the slide, we've got our 5 investment strategies listed at the top. On the left-hand side, we've got the metrics defining each of those 5 strategies. Let's look at the standard fund list that I'm sure you are all familiar with and indeed have been using over the past 12 months. Let's now look at the first new addition to our solutions framework. On the 1st of November, we launched the MFP Stable Hedge Fund Model Portfolio, and it falls into the short-term category, targeting CPI plus 2 net of fees over a rolling 3-year period. In the medium to long term category, we've added the MFP Focus 7 tax-free savings model portfolio, and this portfolio complies with tax-free savings account requirements. And then lastly, on the 1st of September, we launched the new MFP Focus 7 Unconstrained Model Portfolio, the new construct speaking to risk, covering both 50% local equity and 50% offshore equity to make sure that you reach alpha to the maximum for those clients. And then the last new enhancement is the MFP Growth Hedge Fund model portfolio in the same long-term category. True to form, our MFP flagship fund range portfolios are not solely managed by MFP or Momentum, but by independent fund managers. Let's look at who we've partnered with for the new enhancements. The MFP Stable and Growth Hedge Fund model portfolios will be managed in conjunction with Peregrine, 361, Fairtree, and Amplify. Moving on, the tax-free savings account model portfolio similarly is managed by Coronation, Visio, Catalyst, and OneVest. And last but not least, the new unconstrained model portfolio is managed in conjunction with Fairtree, 91, Momentum Investments from a global perspective, Netgroup Investments, Truffle, and Curate. I hope that you are all as excited as we are about these new additions. And with that, it's my pleasure to hand over to Sanisha Pakarasamy, Chief Economist, and Tsiamo Masike, Economist, who will take us through growth gambits in geopolitical gales, a look at global and local forces shaping the road ahead. Sanisha and Tsiamo, over to you.
Thank you, Therese, and good day, everyone. We are witnessing a landscape marked by shifting power dynamics, diverging inflation, and a cautious sense of optimism. From policy changes in the United States and fiscal challenges in Europe, to China's efforts to combat deflation and South Africa's ongoing reforms. We will unpack how these developments are influencing growth, stability, and investor confidence. Sanisha, let us dive into these critical issues and unpack what they mean for the economy and the investment outlook.
Well, thank you, Tsiamo. So I think at the beginning of the year, we all started cottoning on to what kind of policies were going to come out of the US administration regarding protectionism and tariffs. But the big unknown, of course, was how the other countries were going to respond. Were they going to come with retaliatory policies? Were we going to see other trade arrangements being made outside of the US? And I think given that we have seen a number of trade deals forming outside of America, this has contributed more positively to growth in the first half of the year. We saw an element of front loading of imports for US corporates, and this was really to avoid the tariffs that were pending. And that, of course, gave quite a big boost to your inventory levels. And higher inventories also contribute more positively to economic activity. And then quite a positive development relative to the pandemic, and this was around a rerouting of supply chains. Now, if you think back to COVID-19, the pandemic, China was on an extended lockdown. Companies got quite nervous about how they were going to get the raw material inputs from Asia that they needed for their own manufacturing processes. This time around, we've seen that corporates have learned hard lessons and have now started to reroute some of these supply chains. So products came through a lot quicker, and that also contributed to the outcome of GDP for the first half of the year. Ultimately, we also saw that fiscally and with monetary policy, there was also additional support lent to economic activity. So we saw governments around the world spending more from the fiscal side, particularly on your infrastructure, but also military and defense systems. And then we also saw that central banks continued to cut interest rate policy. That, of course, lowers the rate of borrowing for consumers and businesses. And so that adds to economic activity. And then last but not least, I would also put in there the boom that we saw from artificial intelligence or technology. So quite a lot of data centers being built around the world. So that contributes to fixed investment spend. But the nice output from there is higher levels of productivity. So encapsulating all of this, I think there was quite a bit that we didn't really know was going to contribute quite positively to the first half of the year.
Those are indeed a lot of factors that have supported the economy. But has the resilience witnessed in the first half of the year now carried through to the second half of the year, or are we starting to see some risks creeping in?
So I would say that there is some complacency that is setting into financial markets, given that we had this robust economic activity in the first half of the year. And one way that we can see this is through the Bank of America survey for global fund managers, where they ask them, what do they think is going to happen in the next year? Is there going to be a hard landing in the economy? In other words, like a recession? Is there going to be a soft landing? So continued growth, but at a softer pace, more tempered? Or is there going to be no landing? In other words, the global economy just carries along at the same economic momentum. And I think what was quite surprising in the October results is that a third of global fund managers expect no landing.
Okay.
And so given that, the front loading of those imports is now largely in the base, and we also have to take account of the economic delays from the shutdown in the US economy, there will be an impact coming through for economic growth that I don't think is fully being encapsulated by market expectations. There's also an issue around when tariffs actually impact businesses in America. And so for this point in time, they're not really fully experiencing the full tariff rate because of those inventory discrepancies when they import the goods, when the tariffs are actually allocated. And so the full impact of tariffs is yet to actually hit the US economy and spending on that side of things. In addition to that, if you remember the first half of the year, we had a positive surprise when the trade issues actually de-escalated between the US and China. And now going into the fourth quarter of the year, they've picked up again with the US administration promising to increase tariffs even further on Chinese imported goods. And we also know that Donald Trump has also threatened to put an additional tariff on India as a penalty for importing cheap Russian oil. So again, we've got, more turbulence around the tariff policy coming through quite strongly. And then across the Atlantic, we also have some issues in Europe, which could dampen growth the second half of the year. In particular, I'm thinking about the policies that we've seen coming out of the French economy. We now have the fifth prime minister under Macron's second term. Macron is the French president, Emmanuel Macron. They have quite a turbulent situation around the debt dynamics, and there's no clear answer as to how they're going to rein in that fiscal deficit. And remember, what's happening in France is just one item within the entire European region that is showcasing a big rise in populist policies and populist support, which can be quite damaging for socioeconomic implications. And I think altogether, this does paint a picture of slowing momentum in economic activity for the second half of the year.
I think another development that came up was the US government shutdown. So while government shutdowns have not typically affected equity markets historically, they do add a layer of uncertainty and raise political and economic stakes. We also know that it's not uncommon for lawmakers to easily unite on budget measures, and we have seen extensive shutdowns in the past. Can you walk us through what triggered the 2025 shutdown and why does it actually matter for the economy?
Well, at the crux of it, the main issue was essentially the extension of the health and medical tax credits. Now, this matters a lot for those that are buying medical insurance in the marketplace. And if these tax credits are not extended, it does mean that medical inflation will then pick up between 4 and 8% over the next 2 years per annum. And so that can have quite a big implication for consumers' pockets. Now, we know that shutdowns, because they're not really all that uncommon, they don't typically affect equity markets, but they do affect the real economy because policy uncertainty tends to spike, and we also see some dampening impact on consumer sentiment. Now, if we go back to the back end of 2018, we had one of the longest shutdowns, almost 35 days. And during that period, we saw that consumer sentiment drop to its lowest level in more than 6 years. And so if I look at consumer sentiment as we stand today, it's about 5 percentage points above its all-time low. So consumer sentiment in America quite depressed. And so that means that any other negative news could actually tip over that negative spending, negative sentiment, actually dragging down GDP growth. And what worries me right now is that the Bloomberg median consensus for the fourth quarter growth number in the US is still sitting quite high at 1.2%. And I'm not quite sure if that consensus is fully factoring in some of these downside risk factors that have crept in. And of course, a lot of this downside risk from the shutdown comes through from workers being furloughed. And that means that they don't really get paid while they're not operating in office. And they only get that back pay once they come back. And so there's quite a big chunk of purchasing power that's actually pulled away from economic activity for the fourth quarter number.
On a positive note, though, we have seen efforts by President Donald Trump's administration to broker a peace deal between Russia and Ukraine. And more recently, he was successful in securing a ceasefire deal between Israel and Gaza just before the second anniversary of the conflict. How significant is this development? And could it ease some of the central bank demand for gold that's been partly driven by geopolitical risks? We've seen gold prices recently break above the 4,000 US dollar mark, and foreign central banks now hold more gold than US treasuries for the first time since 1996.
Okay, well, Samuel, you touch on the issue of Russia. And
Yeah.
so, if we look at the president in Russia, Vladimir Putin, he hasn't been that excited to get to the negotiation table in terms of brokering a peace deal with Ukraine. And I think that's because Putin wants one last crack at that line of defense. And I think when it becomes quite apparent that Russia's not going to be able to annex more land in Ukraine, that's when the situation starts to look like they may not win more of the war. I think that's going to push them towards the negotiation table. And then we can see some sort of peace agreement being put into place. I think that economic pressures are starting to pick up quite considerably for Russia. We've already seen quite a steep drop in their revenues from fossil fuel sales. Now, we know that they found alternative markets outside of Europe. They send a lot of their stuff to emerging markets, including India. But of course, that has come with a price drop. So the overall revenue in rubles has actually come down. And so there is a lot more economic and fiscal pressure for Russia, meaning that they do need to get to that negotiation table at some point. If we think about the peace deal that's been brokered in Gaza, I do believe that's going to reduce that immediate geopolitical risk. But if you want to have a longer peace process in place, it means that all the action items on that peace deal need to be adhered to. There can't be any ifs and buts coming through from Hamas or any other parties that are conditional to this agreement actually fulfilling a peace agreement in the region. And so while I think for now we could get a bit of a lull in geopolitical activity, this has always been a hotbed for geopolitical risk, the Middle East in general, because of these long-standing ideological issues. And I think this could potentially come up again in future, especially if this plan is not adhered to very strictly. Now you ask about, the demand for gold, and I do believe there's a structural underpin for central bank demand for gold. We've seen quite a sharp pickup in the gold price, which means that we maybe see a tactical pullback, but I think there is a structural force underpinning demand there coming from central banks because they are largely price insensitive at these levels. They want to buy gold because of geopolitical risk, and emerging markets still have quite a long way to go before they get to those average world levels of FX reserves.
So continued support for gold is not completely off the cards. I think maybe turning to Asia, China has been grappling with deflationary pressures. How is the government there responding to this? And more broadly, what can we expect in terms of global inflation and the direction of interest rates?
Well, China has a couple of things in their toolbox to make the economy pump again. The one is on fiscal stimulus, and they have been issuing a number of special infrastructure bonds. So that pushes up your fixed investment angle, and that contributes to economic activity. And then on the monetary policy front, they still have a bit of room to actually cut lending rates to spur borrowing for consumers and for businesses. Now, in China, we've seen over the last 2.5 years or so that pipeline pressures on inflation have actually been in negative territory. So we have deflation from a pipeline measure perspective in China. And as a result, we've seen that China has exported this deflation to the rest of the world. So while they aren't actually exporting as much to the US, they have found other markets like Africa. And this has caused quite a big divergence in inflation outcomes in the world. So the rest of the world experiencing tariffs like a demand shock. So that's been disinflationary, positive inflation, but falling inflation. And for the US economy, it's actually been a supply shock because that's the economy that's actually imposing the tariff on other countries around the world. And so that's actually been pushing up price pressures in the US market. Now, even though the US is likely to see inflation picking up over the next couple of months or so, the market still believes that interest rate cuts are forthcoming in the US. So if I look at Fed futures, they are pricing in up to 4 interest rate cuts by the end of 2026. But with that inflation divergence in the world, that has now led to a monetary policy divergence in the world. So while the US is expected to cut by 4 times, the ECB is probably going to stay on put levels until we get to the end of next year. If we look at the Bank of England, they are still contending with high levels of inflation, particularly on the wage front. And so even if we do get interest rate cuts there, it's probably going to be a second half of 2026 story.
Okay, so turning to South Africa and picking up on that interest rate theme, the South African Reserve Bank recently announced that its preferred inflation level is now 3%, down from 4.5% previously. Markets have viewed this favorably, and once formally announced by the finance minister, it will yield some benefits such as lowering borrowing costs for government, businesses, and consumers, while also supporting purchasing power. What are the risks for the inflation and interest rate path?
So even though all the stars have aligned for inflation in South Africa, I still think there are some key upside threats. The one is coming from the electricity tariff. We know that the energy regulator, NERSA, made a small little error of 54 billion rand on Eskom's revenue calculation. And so that means that consumers are probably going to face an increase in their electricity tariff of between 8 and 9%, not only for next year, but the year after that as well. And so that's quite a long way off from where they want to target inflation in SA. And on top of that, medical aid inflation, which is your second biggest component of services inflation, the first being rental inflation. Here, looking at the medical aids out there, I mean, including some of our competitors from a health business perspective, it looks as though those tariffs are going to come somewhere between 7.5% and 9.5%.
Quite high.
So it's quite high and quite a bit above, the rate of inflation that they want to target. And so we see those as key upside threats. Now, fortunately for us, the rand, despite all the geopolitical turmoil and the local political upheaval, has actually been quite contained. And so we've seen quite a well-behaved currency domestically, partly because of a weaker dollar since the start of the year, partly because of this risk-on sentiment in global markets, but also because of a positive terms of trade. So in other words, the stuff that we export to the world, such as gold and platinum, have gone up in price by 55% for gold, almost 80% for platinum, whereas the stuff that we import, like oil, has come down. So the price of oil since the start of the year down 15%. And so that has contributed to a favorable terms of trade and favorable rand outcomes for South Africa. And we have also seen that inflation expectations have been trending lower. So analysts believe when the Reserve Bank says that they are going to target 3%, and those expectations have now adjusted lower. So for us to eventually get to that 3% target and make it easier for the finance minister to make that decision, I do think we need to be able to see fiscal prudence in order for it to be successful and for inflation expectations to head lower. I think if all those stars align, then we could potentially get more cuts in interest rate policy, potentially one in 2026 of 25 basis points and another in 2027.
That would be good for the consumer. So earlier on, we spoke about how other countries are trying to shield themselves from trade tariffs and these shifting power dynamics. With the African Growth and Opportunity Acts, popularly known as AGOA, having expired on the 30th of September this year, there is uncertainty over its renewal, and this has heightened concerns about South Africa's trade relations with the United States. How are trade talks with the United States evolving now?
Well, we started off on a bit of a rocky front. But it looks as though the framework deal is developing as South Africa has made some concessions and tried to meet the US on middle ground with things like importing poultry and blueberries and liquefied natural gas and committing for South African firms to invest more in the US. But outside of the trade issues, I think for us to truly repair relations with the US, we also need to address a number of policy issues. And there are three that come to mind. So the first is around including null compensation as a line item in the expropriation bill. The second is we need to become, really push having an ambassador to the US. And I don't think we've made enough strides in that regard. And we need to have this being someone that the US can take quite seriously in trade and investment relations with South Africa. Thirdly, I think, South Africa has been blamed for taxing capital on arrival. And this has been through the BEE policies and regulations that has been quite a dampener for foreign capital. Now, outside of the US, because they account for less than 8% of our exports, South Africa has been trying to deepen trade ties with other Asian markets, Middle Eastern partners, even other African nations. But I think a lot more needs to be done for South Africa to increase its exports to the rest of the world. So as an example, we need to make sure that we have enough foreign trade representation across the world to showcase South Africa. We need to have more trade fairs to show where South Africa can be competitive in this export landscape. And lastly, we need to align with global standards. Other countries are embarking on processes of digitizing customs and having tracing requirements. And so if we go that route, it will make it much easier for South Africa to get our products into other countries.
Talks of trade diversification are encouraging, especially given our weak economic growth. SA's economic growth did surprise on the upside in the second quarter of 2025, but both consumer and business sentiment weakened in the third quarter. The Government of National Unity has provided a degree of stability, but optimism has faded, and we have the next round of local government elections coming up between November 2026 and January 2027. The elections are a while away, but we are already starting to see some political activity pick up. How might sentiment on the ground shape the election outcomes, especially given the rise in service delivery protests and growing concerns around the security cluster being unpacked in the Madlanga Commission?
Well, a lot of what you mentioned here really impacts the consumer negatively in terms of sentiment. And if we talk about service delivery protests, these are actually monitored by Municipal IQ, and we've got data for the first half of the year. But if we had to say that the same number occurs in the second half, this year could be the highest on record in terms of the number of service delivery protests, and that really talks to ANC failures in a number of metros. Now, if we think back to the 2021 local government elections, the ANC might actually struggle to retain support in some of the key metros. Their margin of victory in Tshwane, City of Johannesburg, Ekurhuleni was extremely thin back then. And so you only need a little bit of a shift in order for the ANC to lose that power base. And I think what adds to the complexity of the local politics in South Africa here is the fact that Democratic Alliance Helen Zille is now going to be running for the mayoral position in Johannesburg, and that could alter the dynamics for Gauteng as a province. And that, of course, can then lead to a lot of complexity come time of the 2029 national elections, where the balance of power can be significantly altered, and we could potentially see coalitions in quite a different shape or form.
So let's turn to the network system. Kusile Unit 6 came online, and Kusile is now fully operational after 17 years since the investment decision, and at a final cost of roughly 161 billion. This is almost double the original estimate. Nevertheless, Kusile and Medupi power stations combined now deliver up to 9,600 megawatts when they are fully operational. Furthermore, the number of unplanned shutdowns has also come down, and this signals tangible progress on the ground. Beyond that, we've seen steady progress on momentum, particularly across the three sectors that make up 80% of our infrastructure, and that is energy, logistics, and water. And I think this continues to anchor our positive outlook for economic growth in the medium to long term. Can you give us a sense of what's been achieved on the reform front, especially relating to these three sectors over the past quarter?
Well, maybe let's start with energy. We know that there has been a lot of interest in renewable energy from the private sector, to the extent that we actually ran out of transmission grid in 5 of our provinces. And so now government is making additional steps to ensure that we have enough transmission network, and we will be soon entering phase 1 where the actual investment will start hitting the ground, and that also involves a lot of foreign interest in terms of the funding for that. If we look at the water space, in August, a number of legislative pieces went into Parliament to try and split the water service providers out of the water service authorities. And what that does is that it then enables the private sector to begin to play in that space to become providers of water. And we can actually increase security of water supply and sanitation services there. We've also seen a ring fencing of revenues at certain municipalities on the local government side. So that means that the water and electricity revenue that they receive then gets reticulated into infrastructure for water and for electricity, so that we don't have the situation in Joburg where more than 45% of the water is lost through leakages. And then finally, in the logistics sector, we've seen that 11 private freight operators have now been granted conditional access to more than 40 of the railway corridors in South Africa. So that would include sugar lines, manganese, ferrochrome, coal, etc. And ultimately, what that does is create a far more competitive landscape in logistics, which can help to lower prices in future.
It's indeed positive that South Africa's reform momentum is moving in the right direction, even if slow at times. Of course, the path ahead won't be without challenges, from subdued growth and political uncertainty locally to global headwinds like trade tensions and policy shifts in major economies. It is a complex environment, but one that still offers opportunities for resilience and renewal if momentum is maintained. Thank you.
Thank you both for those valuable insights. That bigger picture really helps us understand the environment our clients are navigating and why long-term thinking matters in uncertain times. Next, we turn to Curate Investments, which celebrates its first year within our MFP Wealth Solutions framework. Please welcome Nkosana Nzima, who will take us through Curate Turns 1, simplifying complexity and delivering outcomes, showing how Curate streamlined the investment journey while preserving the quality and the intent of advice. Nkosana, over to you.
Thank you, Therese. Good morning, everyone, and thank you for having me. It's hard to believe that just over a year ago, Curate was still a concept, a vision to simplify investing by handpicking the best managers from around the world. We weren't trying to build another asset manager. We set out to reimagine how investing could feel in a world that's constantly changing, to bring calm in the chaos. And 1 year later, that vision is taking shape. Today, Curate oversees more than 53 billion rands in assets across 13 funds, and 6 of those funds already rank in the first quartile since inception. That tells us our process of curation is working. But growth isn't only measured in numbers. It's about partnership and presence, particularly with MFP. Our funds are embedded in your models, used as satellites in portfolios, and trusted as part of the MFP Wealth Management proposition. So, as we reflect on the past year, it's really a story about our shared success, simplifying complexity and delivering outcomes for your clients. Let's start where most clients start, cash and income. Our Curate income range sits at the heart of the MFP income and cash strategy, the only funds in that category, which speaks volume about the confidence MFP have placed in these funds. The 3 Curate funds are designed to meet different client needs: enhanced yield, liquidity and short-term needs; flexible income fund, balance of yield and tactical positioning; income plus fund, cornerstone income with capital preservation. When we think about income investing, It's not just about yield, it's about stability and predictability. If you look at the past 2 decades, from the global financial crisis to COVID and the recent rate hike cycle, volatility in bonds and cash has been quite significant. Yet, across every one of those events, Curate's income funds have stayed remarkably stable, showcasing the skill of the Momentum fixed income team in managing these funds through the cycle. In Q3, all 3 funds delivered positive returns again. Curate Momentum Flexible Income was up 3.1% for the quarter, outperforming peers and its Steffi Plus 1.5 benchmark, driven largely by nominal bond and floating rate credit exposures. For the Curate Momentum Enhanced Yield, every investment contributed positively, with credit spreads tightening and selective positioning boosting performance. And what's more impressive is that over the last 10 years, Enhanced Yield has delivered mostly positive monthly returns, typically between 0.3% and 0.8%. That reliability is what makes the fund a trusted anchor where clients need liquidity without giving up on meaningful yield. Now, MFP is no stranger to the Curate Momentum Income Plus Fund, and the continued support we've seen from this channel speaks volumes. The good news is the fund once again delivered, returning 3.1% versus 2.4% for its benchmark over the quarter, with steady contributions from government and corporate bonds, and the rand strengthening adding to returns through the currency hedges. What's more telling is the consistency behind those results. If we take a step back and look at how 100 rands invested at inception has grown, you can see the story of steady compounding unfold. Through the cycles, credit events, and volatility, the fund has kept delivering quietly, doing exactly what it was built to do: generate strong returns with relatively low volatility ahead of both inflation and low equity stable type mandates. This reliability is what makes it such a trusted anchor in client portfolios, providing peace of mind through stability, not speculation. Together, these 3 funds provide advisors with a complete income toolkit, balancing preservation, enhanced yield, and flexibility. That's simplifying complexity in practice. Now, for clients with medium to long-term horizons, let's move to Curate's local fund range that are more geared to providing capital growth. As you may recall, our capital growth range includes 3 portfolios: a multi-asset balance fund focused on capital preservation, and 2 specialist portfolios in equity and property aimed at long-term capital growth. Each mandate managed by an expert in their field, staying true to the Curate philosophy of partnering with specialists. The Curate Momentum Balance Fund, managed by Visio, blends growth and protection. The managers are laser-focused on limiting downside risk, preserving capital through research-driven stock selection. This is how the fund is able to participate both when markets run and, most importantly, protect when markets fall, which is what this slide shows. In Q3, the fund gained 6.2% ahead of its peers at 5.9%. Both local and global equities contributed, with strong performance from resources, notably Anglo Gold Ashanti and Northern Platinum. The fund now sits above 800 million rands in assets, a testament to the growing advisor confidence. The Curate Momentum Equity Fund, managed by Lorem Capital, combines SA Inc. stocks with global equities, giving clients access to opportunities our local market simply doesn't offer. Think global technology and healthcare leaders like AstraZeneca and United Health. That diversification again delivered this quarter, with the fund up 9.8%. It's a reminder that combining local insights with offshore exposure helps reduce concentration risk while unlocking broader growth opportunity. Then we have the Curate Momentum Flexible Property Fund, managed by Sasfigile Capital. Local property outperformed global property in quarter 3, up 5.5% versus 0.5% in rand terms. The fund's overweight to local names boosted returns, outperforming its composite benchmark. But the real advantage of this fund is actually the flexibility of its mandate. While South African property performed well more recently, it only offers 22 listed REITs, where global property provides over 350 listed stocks. So this fund expands the opportunity set, giving exposure to structural growth areas like data centers and senior housing, while still grounded in Sasfigula's deep local expertise. That's diversification in action, turning a narrow sector in South African market into a broad, risk-balanced growth engine that has a good mix of yield and growth, as it can be seen on this slide. With Regulation 28 now permitting up to 45% offshore exposure and clients increasingly becoming global citizens, earning in one currency, investing in another, and retiring elsewhere, global diversification has never been more relevant. It's about capturing opportunity while reducing drawdowns and enhancing portfolio resilience for the long term. That's where our global funds come in, a combination of enhanced index solution and high conviction active strategies. What truly sets these funds apart is the specialist global expertise your clients now have exclusive access through Curate, effectively bringing true global expertise and investment skill right to the South African shores. The two funds managed by Robeco offer smart alternatives to traditional passive investing. They track the same developed and emerging benchmarks, but apply a systematic, data-driven process designed to deliver consistent outperformance over time. And the results continue to validate that approach. In the third quarter, the Curate Global Sustainable Equity Fund rose 7% in dollar terms, slightly behind the MSCI World benchmark, but ahead over the past year, as shown on the slide. The Curate Global Emerging Markets Equity Fund gained 10% in dollar terms, supported by an overweight to goldfields and other South African material stocks. Both funds remain cost-effective, low tracking error solutions that aim to generate steady alpha without the emotional bias often seen in active decision-making, a true example of simplifying complexity for client portfolios. We then move to our global active range, three distinct styles designed to complement one another. In the third quarter, the market backdrop was dominated by strong performance from growth and cyclical sectors. Against this backdrop, the Curate Global Growth Fund, managed by Jennison Associates, gained 5% in dollar terms, with top contributors including AppLovin, a mobile gaming enabler poised to capture share in fragmented industry. The fund remains focused on companies driving transformational change across AI, healthcare, innovation, and digital platforms. The Curate Global Value Equity Fund, managed by Lyrical Asset Management, returned 2.7% in dollar terms, held back by its disciplined avoidance of expensive mega-cap growth stocks. But that very discipline, buying quality businesses at roughly half the market valuation, underpins its long-term edge as valuation normalizes. The Curate Global Quality Equity Fund, managed by Evenlode Investment Management, faced short-term headwinds as growth and value dominated, yet fundamentals remain robust. Its focus on durable, cash-generating businesses positions it well for when market attention shifts back to earnings resilience and fundamentals. And this slide illustrates just how distinct these portfolios are. Each manager brings a unique lens: growth, value, and quality. And as a result, these funds perform differently at different points in the cycle. That's not a flaw. That's exactly the design. Diversification across styles helps smooth long-term returns. In short, blend is your friend. And this slide captures that beautifully through their top 10 holdings and weightings. So, as Curate turns 1, The story is simple. We've simplified complexity by hand-picking exceptional managers across income, growth, and global strategies. And we've delivered outcomes: consistent performance, diversification, and trust in volatile times. Behind every chart and return are real people, advisors and clients, making progress towards their goals. So, to the MFP community, thank you for being such a crucial part of Curate's first chapter. Together, we're proving that when you curate with intent, you create calm in the chaos and real outcomes that last. And if you're looking for any support, the Curate Fund Specialist team is here to help, working alongside the MFP Wealth Management team to show how the Curate funds can complement your portfolios and integrate seamlessly with the MFP models and fund of funds. Thank you.
Thank you, Nkosana. It's incredible to see how far Curate has come in just 1 year, showing that both simplicity and sophistication can go hand in hand in modern investment design. Next, we're joined by Flobella Yates, or Flof, as we all know her, the MD of Equilibrium, who will explain why DFMs are becoming the smart choice for building more consistent and reliable investment strategies. Flof, over to you.
Thank you, Therese. Good day, everyone. As you may recall, MFP made the decision to appoint Equilibrium as your investment team. As an independent discretionary fund manager and multi-manager, we work closely with MFP's wealth management team to ensure that everything we do is aligned to your advice proposition. I'm not sure if you are aware, but MFP was actually ahead of the curve in identifying the benefits of using a DFM. Every year, we get NMG to do some analysis for us on advisor trends, and over the past 5 years, we've seen advisors increasingly turning to DFMs like ourselves to assist them with strategic and tactical asset allocation, manager research, portfolio construction, mandate selection, and consolidated reporting. I thought it might be interesting to share a few of the findings with you. Although only 62% of advisors interviewed last year were using a DFM, 80% of them stated that they would be using a DFM within the next 3 years. Another trend we've seen amongst advisors is the reduction in the use of multi-asset funds in a portfolio construction towards more single asset class solutions, something that we have been doing since the inception of our outcome-based investment philosophy. As you can see, the reasons why advisors choose to use a DFM mainly relate to them not having the necessary investment expertise, tools, or the ability to compete with the DFM in terms of fees. When we asked some of our top MFP advisors their reasons for supporting us, they stated similar reasons, but the 4 key ones they mentioned were: as your investment team, you can sleep easy at night knowing that there's an entire team of individuals focused on local and international markets, doing the due diligences, monitoring mandate compliance, and ensuring that the portfolios perform in line with our expectations. By utilizing our full assets under management, we're able to give you access to preferential fees. Where we negotiate preferential fees, we don't take any markup. We pass the entire preferential fee directly onto your client, a huge benefit to the client. And in many cases, you might already be using the same fund, but your clients are paying the retail fee class, which is more expensive. If you use the focus models or the momentum fund of funds, you will automatically get the reduced fee class. And then the 4th reason mentioned is consolidated reporting. Instead of you having to pick up 6 or 7 different fact sheets and then try to work out the performance of each, the overall asset allocation, and the top holdings for your client, our monthly fact sheets and quarterly reports provide detailed consolidated reports. Not only does this save you time, but it enhances your communication with clients. And the last reason, of course, is treating your clients fairly. The TCF benefits all our asset allocation and underlying manager changes are implemented simultaneously across all your clients, ensuring that you have the benefit of our best ideas as soon as we make them. During our engagements with MFP advisors, I found it interesting how few knew who the investment team consisted of and also the depth of that team. So I thought it might be worthwhile reminding you of the key members of the team. This is the key Equilibrium team, comprising of investment professionals, distribution and operation members that work behind the scenes to ensure that you can focus on what you do best. Give your clients the best financial advice, secure in the knowledge that we are managing our combined clients' investments. So although you might know the majority of the Equilibrium team well, it seems that few of you know that we are supported by a much larger team, both locally and globally. In-depth research on economies, asset classes, asset managers, and investment strategies around the globe requires a big team with decades of experience. Our ability to leverage off their specialist skills from around the globe is one of the primary reasons our performance has been so good, and I believe we have been so successful in meeting our clients' investment outcomes. The last question that I have been repeatedly getting from MFP advisors is how Curate fits into our process. So as I've already mentioned, we are the group's discretionary fund manager or multi-manager. Curate is the group's single manager. They too identify world-class managers, but they typically only pick one to execute per strategy, whereas we would pick several in building a diversified portfolio. So for us, Curate would be evaluated in the same way as any independent third-party asset manager, and they would be selected on merit in our constructs. For us, we're more interested in the overall building block blend than in each single manager. When we put together portfolios, each manager plays a role. So you'll notice that we do use some Curate funds in our portfolios, and also that there are some Curate funds that use the same asset managers that we do, but sometimes they've chosen a different underlying fund that manager uses. What does this mean for you? By using an MFP focus model portfolio or momentum focus fund of funds, you can rest assured that you are using a diversified portfolio that is managed for a particular outcome. Advisors who don't feel that one portfolio alone meets their needs can also consider a Curate fund alongside the model portfolio or fund of funds. Thank you for your continued support, and I'm encouraged to see our partnership grow from strength to strength.
Thank you, Flo, for that clear and practical perspective. Understanding how DFMs help advisors deliver consistency and scale is so valuable as we guide our clients through uncertain markets. Next, we turn to Rupert Gissing, Portfolio Manager at Equilibrium, for a full update on the MFP multi-managed solutions. Rupert, the floor is yours.
Thank you, Therese. Global financial markets posted strong gains in the third quarter of 2025, driven by robust artificial intelligence and technology demand, solid corporate earnings, and a well-anticipated Federal Reserve rate cut. A weaker US dollar supported emerging markets. Although US trade policy wasn't in the spotlight as much as earlier in the year and some progress was made, there's still a lot of uncertainty. Businesses around the world are changing how they manage their supply chains to rely less on the US and China, which have been at the center of recent trade disputes. Even though markets performed well, there are still risks. Valuations are high, inflation remains a concern, and global political tensions could still affect market stability. US stocks had a strong third quarter, with the S&P 500 rising by 8% in US dollar terms. There were a few bumps along the way, especially after the July jobs report and a sell-off in government bonds in September. Still, solid company earnings and a stable economic environment helped support the market. Inflation in the US ticked up slightly in August, but the impact of new tariffs was less severe than expected. This gave the Federal Reserve room to cut interest rates by 0.25% in September, its first rate cut of the year, and it signaled that more cuts could follow, which gave further support to US equities. Developed market equities, as measured by the MSCI All Countries World Index, or ACWI for short, ended the quarter up 7.3% in dollar terms and 4.1% in rand terms, as a strengthening rand detracted from the returns of global asset classes. A general risk-on environment caused emerging market equities, as measured by the MSCI Emerging Markets Index, to outperform developed market equities during the quarter, up 10.6% in dollar terms and 7.4% in rand terms, for a return of 17.5% over the past 12 months, on par with the return from developed market equities. The strong performance was mainly driven by big players like China, Taiwan, and Korea. Progress in US-China trade talks helped to boost investor confidence, while continued excitement around AI-related companies also added to the positive momentum. Global bond markets were volatile throughout the quarter as political uncertainty and concerns around fiscal sustainability came into focus. Nonetheless, the FTSE World Government Bond Index eked out a positive return, up 0.6% in US dollar terms, and down 2.8% in rand terms, mainly supported by US Treasuries. European and UK bonds ended the quarter marginally down. Global property had a positive quarter, up 4.2% in US dollar terms and 1.2% in rand terms. SA equities extended their rally in the third quarter, with the FTSE JSE Capped SWIX All-Share Index up 12.8%. Having a closer look at the performance of the underlying JSE sectors over the past quarter and year, it is clear that returns have been dominated by the resources sector. It was underpinned by strong gold and platinum prices. Resources were up a staggering 46.8% for the quarter and has almost doubled over the past 12 months, up 86.4%. On an individual share basis, Anglo Gold, Ashanti and Goldfields were up 47% and 72% respectively in quarter 3. Platinum shares, Valterra Platinum was up 59% and Implats up and also 38%. Returns from the industrial and financial sectors were up much more muted, 3.7% and 1% respectively for the quarter. Even though industrials delivered a solid 19.8% over the past year, it seems pedestrian when compared to returns generated by resources. As part of the so-called SA Inc. shares, the financial sector remains under pressure, delivering 6.3% over the past year. It is important to remember that similar to the US S&P 500 index, the local rally is currently fueled by a narrow group of shares, and as a result, concentration risks are elevated. We'll unpack the significant rally in the gold price and the impact on portfolio performance a bit later. I thought it would be prudent to remind ourselves of how quickly things can change, and to put it in perspective, let's take a look at the performance of the different sectors as at the end of last year. Recall that post the local elections, financials and industrials had a strong run. Financials and industrials were up 20.1% and 18.7% respectively, while resources lagged significantly, down 6%. It was also just after the US elections, and concerns around what the global impact of the Trump administration and potential tariffs on the demand for resources would meant that the sector was a significant underperformer and detracted from the performance of local equities. Quite a different picture to where we find ourselves only 3 quarters later. In a volatile, unpredictable and sentiment-driven market, where geopolitical uncertainty, fueled by unpredictable US policy and heightened conflict, high levels of sovereign debt in developed markets, and the ongoing debate on the future of the US dollar as a reserve currency remains topical, one has to take a step back in order to assess the environment on an ongoing basis. During times like these, diversified portfolio construction is more important than ever, and chasing specific themes can have a detrimental impact on the potential long-term outcome of investment objectives. Back to the quarterly market review. Local property, as measured by the FTSE JSE All Property Index, gained from falling local bond yields and positive earnings guidance from company management, up 5.5% for the quarter, for a solid return of 11.4% over the past 12 months. SA nominal bond yields rallied further in the third quarter as the South African Reserve Bank, or SARB for short, confirmed that the 3% bottom end of the official inflation target range was now their preferred goal. Strong foreign demand was also evident for local bonds in the quarter. The JSE All Bond Index, or ALBI for short, delivered 6.9% for a return of 14.5% over the past 12 months. Cash, as measured by the STEFI Composite Index, was the clear underperforming local asset class in the third quarter as the SARB continued to cut policy rates. Though still delivering inflation-beating returns of 1.8% over the quarter and 7.8% over the past 12 months. The rand continued its strong run and gained roughly 2.1% against the US dollar, supported by dollar weakness and higher gold prices. As we can see on the following chart, the rise in the gold price has been relentless. At the beginning of the year, we were just breaking through the $3,000 per ounce, and now we are sitting at over $4,000. If we go back a bit in history and observe the gold price over the last 50 odd years, we can see that we've been here before, as there were two significant spikes in the gold price in the early 80s and then again in 2010 post the global financial crisis. The classic Warren Buffett saying comes to mind: be fearful when others are greedy and be greedy when others are fearful. What is also notable is the extended periods of stagnation in the gold price between these excessive price movements. If you bought gold in 1980, you had to wait 26 years to make your money back in nominal terms. As one does these days, I asked AI to give me a summary of the spikes in the gold price in the early 80s and then again in 2010, and here's what I got. The gold price spiked in the early 1980s due to high inflation, economic uncertainty and geopolitical events like the Iranian hostage crisis. Investors sought a safe haven as the US dollar was weakening and inflation was soaring, which made gold, an inflation hedge, increasingly attractive. This culminated in the price hitting a record high in January 1980. Then I did the same for the early 2000s, post the global financial crisis, and here's what I got. The gold price spiked in the early 2010s due to the European sovereign debt crisis following the 2008 financial crisis, combined with continued low interest rates and a weak US dollar. Gold's status as a safe haven asset during times of economic and geopolitical uncertainty made it a popular choice for investors seeking to hedge against risk and currency devaluation. Now, doesn't this all sound too familiar? Yes, we can argue that this time it's different, and yes, perhaps it is, and it is structural. But does that mean that the gold price continues to go up indefinitely, or does it mean that it stabilizes in the new normal? Or does it mean we see a correction like we did the previous two times we saw this flight to safety story playing out? The truth is, nobody really knows. Gold's value is ultimately a social construction. Its worth is sustained by our collective agreement about its importance and our belief in its future value. Gold's physical properties, its shiny quality, relative scarcity, durability, and difficulty in extraction drives its perceived value. Due to the current geopolitical environment, as mentioned earlier, elevated central bank buying of gold has continued unabated since 2022, as seen on this chart, continuing to drive the price of gold up to all-time highs on an ongoing basis, as we saw on the previous chart. Historically, there has been a strong relationship between the gold price and the value in US 10-year Treasury inflation-protected securities, or TIPS for short. These are US government bonds with a 10-year maturity. Consider the following. As can be seen on this chart, dating back to 2004, since the elevated central bank buying of gold started, highlighted by the green area at the right of the chart, which coincides with the start of the Russia-Ukraine war, these two have diverged significantly. If one was to use this historical relationship between 2004 and 2022 as a proxy for valuing gold, the spot price should currently be around $775 per ounce, or roughly 80% lower than the current spot price. So, while there could possibly be a structural break in this traditional relationship due to geopolitical reasons, one needs to be careful during times of market extremes to not get too caught up in the hype. As we've unpacked now, a high gold price is often a sign of increased global uncertainty and market fear. It can also lead to sideways movements for years, potentially hindering growth if the market normalizes. This played out post a correction in the 1980s, when I'm sure investors asked themselves the same questions we are asking now, and then again post the global financial crisis in 2010, when it took another extreme event in the COVID pandemic to get it back to these levels, a decade later. This is important in the context of overall portfolio construction. We get gold exposure and more specifically gold miners in the all-share index in the focus solutions through our local equity building block. The valuations of these businesses are closely linked to the gold price, meaning that should there be a correction or normalization in the gold price, this will be reflected in their share price, which could potentially have a significant impact on the returns they generate, which in turn will impact portfolio performance to the downside. Consider the following chart. Due to the rapid increase in valuations and extreme levels of concentration, gold miners are now approximately 15% of the capped SWIX index, the benchmark we use for local equity performance. This is up from 4% before the COVID pandemic, so it has increased almost fourfold. In fact, gold and platinum shares now make up a massive 26% of the index, where the whole resources sector was approximately 8% of the index only a year ago. Exactly as is the case with the Magnificent Seven in US equities, this concentration is causing significant deviations from benchmark returns over the short term for active equity managers due to the underweight exposure they have generally had. One also needs to take into account that risk management is just as important in portfolio management as return generation, and it could lead to deviations in returns from the index or benchmark over the short term. Many equity managers will not be comfortable holding gold companies at benchmark weights, or for that matter, even investing in them, due to the difficulty in valuing these companies. With that being said, let's take a look at how our local equity building block in the focus solutions has performed. Just a reminder of what the construct looks like. We have 25% in the Net Group Investments SA Equity Fund managed by Lorium, 25% in the Truffle SCI General Equity Fund, 20% in the 91 SA Equity Fund and the Fairtree Equity Prescient Fund respectively, and for completion with regards to style exposure, we have 10% in the Momentum Trending Equity Fund. In absolute terms, performance has been very strong, up 28.4% for the year to date and 24.7% over the past 12 months. For reasons as explained above, we can see that our local equity building block has battled to keep up with the capped SWIX index over the past year, lagging by 3.4%. I would, however, also like to draw your attention to the peer group, CISA SA General Equity, illustrating that it has been a tough environment for local equity managers in general, with an average return of 18.7% and lagging the benchmark by almost 10%. The short-term underperformance also has an impact on the long-term numbers. However, over longer time horizons, 5 and 7 years, where we should focus our attention in a volatile asset class such as equities, we are in line with and ahead of the capped SWIX benchmark. With that being said, and taking into account the strong performance from the resources sector over the past quarter, it is very encouraging to see that our local equity building block performed in line with the benchmark, delivering 12.8%. This is then of course also reflected in the performance numbers of our underlying local equity managers, with the Momentum Trending Equity Fund, Net Group Investments SA Equity Fund and the 91 Equity Fund outperforming capped SWIX over the quarter, while both the Fairtree SA Equity Prescient and Truffle SCI General Equity Fund lagged only marginally. Looking at rolling 12 and 36-month numbers, which gives us a much better indication of performance through time rather than snapshot numbers at a specific point in time. The hit rate, or how often we outperform the index over 81 rolling 12-month periods since January 2019, is 58%, with an average outperformance of 2.6% per annum. In other words, we outperformed 47 out of 81 times on a rolling basis and added 2.6% average performance over any 1 year in the process. The rolling 36-month number, which is a more meaningful indication of long-term performance through cycles, shows that the construct has outperformed the capped SWIX index 72% of the time, with an average outperformance of 2.8% per year. So, we outperformed 41 out of 57 times on a rolling basis and added 2.6% average performance per year over any 3 years. Now, let's take a closer look at the overall performance of our multi-asset solutions, the MFP focus model portfolios, and the Momentum Focus Fund of Funds. It was another good quarter for the Momentum Focus Fund of Funds, as well as the MFP Focus model portfolios. MFP Focus 3 was up by 5.4%, while the Focus 5, 7 and 7 unconstrained models were up by 7.2%, 7.7% and 8%. The Momentum Focus Fund of Funds delivered returns of 6.4%, 7.5% and 8% for the quarter for Focus 3, 5 and 7 respectively. Due to continued strong quarterly performance, the one-year returns for all the funds are comfortably ahead of their benchmarks and peer groups. The fund of funds are now also in line with and ahead of their benchmark over their respective time horizons, as well as all other time periods of 3, 5 and 7 years. The MFP Focus model portfolios continue to deliver on their objectives since their launch 54 months ago, with all the portfolios ahead of both their benchmarks and peer groups over the period. From an attribution perspective, our tactical asset allocation calls, in other words, how our portfolios are positioned over the short term relative to their long-term strategic objectives, contributed to performance. However, manager selection, so how the managers we use in the solutions performed relative to their respective benchmarks, detracted overall. Our overweight position in local equity was the biggest contributor from a TAA perspective and also helped to offset the impact of the strengthening rand that detracted from performance of global asset classes. Underweights in global cash and bonds further contributed. Having a closer look at our manager attribution, we see that the Curate Enhanced Yield Fund, our cash manager, as well as the Momentum SA Flexible Fixed Interest Fund that we use for our local bond or fixed income allocation, contributed positively. Then on the global equity side, both the Coronation Global Emerging Markets Fund as well as the Curate Momentum Global Sustainable Equity Feeder Fund contributed positively to performance. Local equity, as discussed earlier, has been the main detractor, with 3 of the local equity managers, including 91, Fairtree and Truffle, underperforming the benchmark over a rolling 12 months on a relative basis. The other one, the Visio BCI Unconstrained Fixed Interest Fund, also detracted. As a more conservative mandate that we use in our fixed income building block in the Focus 3 model portfolio, during times when bonds perform well, we expect it to underperform the ALBI, or All Bond Index. In terms of our current portfolio positioning and outlook, we maintain our preference for local over global asset classes based on valuations and fundamentals. As we continue to see a strong recovery in South African equities, it's worth highlighting that the market still looks attractively priced when compared to its long-term average price to earnings ratio. That's a compelling story for value-focused investors. Importantly, South African companies have relatively low revenue exposure to the US. So, unlike emerging market giants like Taiwan and South Korea, we're unlikely to feel the direct impact of the recently announced 30% tariff hike on SA imports by the US. The SA equity market remains under-owned in global emerging market portfolios, but with South Africa being one of the top performing markets in 2025 so far, we could see renewed interest from foreign investors as well. That could drive inflows and support a further rewriting of the local market. On the fixed income side, SA vanilla government bonds continue to offer some of the highest real yields globally, second only to Brazil in the EM space. On a forward-looking basis, the real yield sits above 5%, which is about 0.7 standard deviations above its historical average since inflation targeting began. And with the SARB now maintaining a downward interest rate cycle, the environment remains supportive for both local equities and bonds. This backdrop reinforces our preference for local over global asset classes based on both valuations and fundamentals, and our overweight position in local equities and bonds. In the global equity space, our current positioning reflects our preference for emerging market equities over developed markets. Why? Well, a lot of the good news has already been priced into US equities. That means the upside potential from here is more limited. And while the Trump policy package brings growth negative elements like high tariffs and tighter immigration, these tend to affect smaller cap sectors such as consumer discretionary, retail and healthcare more. On the flip side, the growth positive elements, including lower taxes and deregulation, are tailwinds for large cap sectors like technology and financials, which continue to support broader market returns. But here's where it gets interesting. Emerging markets are offering a compelling opportunity right now. Valuations are attractive, and we're likely to see more accommodative monetary policy going forward. EM equities are trading at a discount compared to their developed market counterparts, and with a weakening US dollar and strong fundamentals, the outlook for EM investments is increasingly favorable. We remain neutral on global cash and property, as well as local property, due to improved fundamentals and decreasing operating costs supported by solar investments. Let's touch on our positioning in global bonds and local cash. We remain underweight in both. Yes, cash continues to offer investors an above-average prospective real yield, but the landscape has shifted. Since the SARB began its rates-cutting cycle in September 2024, and with inflation on the rise, real cash yields have come down from their previous highs. What does that mean for investors? Well, simply put, the future return potential from cash is now less compelling, especially when compared to the opportunities in South African equities and nominal government bonds. And in closing, in line with our increased emerging market exposure, we are introducing a new fund to complement the Coronation Global Emerging Markets Feeder Fund in the MFP Focus Model portfolios. It is a fund you should all be familiar with, as we have been using it for quite a while in the Focus Fund of Funds, the Curate Momentum Global Emerging Markets Feeder Fund. Increased emerging markets exposure in an environment where we foresee EM playing a more important role in portfolio construction going forward introduces the need for further diversification. Similar to the Global Sustainable Equity Feeder Fund that we use for our developed market equity exposure, the fund is also managed by Robeco. It brings a robust, systematic, data-driven investment process with lower tracking error relative to the benchmark at a lower cost than that of actively managed funds. We will start with a small allocation as it relates to our increase in EM exposure from 10% to 12% of our global equity exposure, and then gradually increase it over time. Ultimately, this enhancement aims to refine portfolio efficiency, broaden our sources of alpha, and enhance long-term consistency of investment outcomes for our clients. Thank you for dialing in, and thank you for the confidence you place in us to navigate uncertainty with both prudence and purpose. See you at the next one. Back to you, Therese.
Thank you, Rupert, for that detailed overview. It's encouraging to see how our funds continue to stay true to our wealth management philosophy, focused on diversification, risk control, and outcome delivery. We now shift gears slightly to something that brings investing even closer to home, personal share portfolios. Please join me in welcoming Janine van Heerden, Head of Business Development at Momentum Securities, who will explain why we call it a personal share portfolio. Janine will show how this offering adds a layer of ownership and transparency that deepens client engagement. Janine, please go ahead.
Thank you, Therese. Good day, everyone. Why do we call it a personal share portfolio? In finance, words matter. They set expectations. That's why the term personal share portfolio, or PSP in short, is deliberate. It reflects a philosophy of investing that puts the individual, their context, ambitions, and legacy at the center. When investors talk about share portfolios, they often mean very different things. Two of the most common approaches are self-managed share portfolios and a portfolio managed by a discretionary portfolio manager, such as Momentum Securities. At first glance, they may sound similar. Both involve owning listed shares directly in your hands, but the way decisions are made and the level of involvement required from the investor are very different. A self-managed share portfolio is exactly what it sounds like. Your portfolio built and managed on your own instructions. Here, you are the decision maker. Ultimately, no trade happens without your instruction. This approach appeals to investors who value control, enjoy being hands-on with their wealth, and have the time to stay informed about markets. The benefit is transparency and alignment with the client's view. But there is a trade-off. It requires time, discipline and market knowledge. Without active oversight, opportunities can be missed or risks overlooked. On the other hand, a portfolio manager by a discretionary portfolio manager is outsourcing the management to a professional. Once you agree to an objective, such as growth, income, or balance, the manager has authority to buy and sell the shares on your behalf. They do not need to phone you before making each trade. This does not mean that the client loses control or transparency, but the ultimate decision-making lies with the portfolio manager. This approach benefits investors who want professional expertise applied consistently to their capital, value agility since managers can't respond quickly to market movements, prefer to focus on the outcome like performance, diversification, alignment with goals, rather than the day-to-day trading. The discretionary model relies on trust. You hand over the steering wheel to someone licensed, experienced and resourced with research teams and risk frameworks. It's less about your personal stock picks and more about applying a disciplined, strategic process, allowing the portfolio manager to select stocks that will reach your client's ultimate investment goals. At Momentum Securities, we developed risk profile models for clients, which provides you with an off-the-shelf solution and is a good starting point for building a legacy. Practically, this allows the portfolio manager to act quickly and implement trades without being delayed by the client's availability to approve trades. Clients will still have full transparency of the holdings and not just the top 10 like with the unit trust fund, but they have the comfort of knowing that the shares are monitored actively. The models can be easily blended with the rest of the client's investments, allowing you to build a completely customized investment for your client. The difference comes down to who's in the driver's seat. In a self-managed share portfolio, the client steers with you, the advisor, as the navigator. In a discretionary portfolio or model portfolio, the client appoints a professional driver while you set the destination. Neither model is inherently better. It depends on your client's personality, preferences, and goals. Some investors even use a blend. A personal portfolio for shares they feel strongly about, alongside a discretionary mandate for the bulk of their wealth, ensuring diversification and professional oversight. In our world, we call this an advisory or a bespoke portfolio. This allows the client to color outside of the lines with the help and guidance of the portfolio manager. It is important to know that at Momentum Wealth and MWI, they do not allow clients to hold self-managed portfolios on the platform. They will only be able to do this with direct accounts with Momentum Securities. PSPs on the platform will always be linked to a model or a bespoke portfolio with portfolio manager oversight. For decades, the industry has favored scale and efficiency, such as pooled funds, index trackers, and robo-advice. These innovations have delivered access, but often at the cost of personalization. The PSP stands as a counterpoint, combining institutional thoroughness with human relevance. Because clients don't want to be seen as just a number, they want something more personal. Most investment products are designed for the average investor. In reality, no such investor exists. Clients differ not only in the risk appetite and time horizon, but in tax circumstances, liquidity needs, personal preferences, and family goals, to name a few. A PSP acknowledges this individuality. It is tailored around each client's context, risk alignment, sector allocation, and even currency exposure. It is built with their story in mind, instead of forcing investors into a template or a cookie-cutter solution. The PSP is molded to fit them, almost like building their own personal fund. Modern investing has become increasingly abstract. Investors are told they own units, ETFs, or pooled exposures. This may be efficient, but it's impersonal. A PSP restores clarity. Shares are held directly in the client's name, so ownership is transparent and tangible. This deepens engagement and control. Clients don't just own units, they own businesses. This shift builds trust, confidence, and a stronger connection to long-term outcomes. And it even gives the client a story to tell. I believe that when you buy a share, we are buying the story of that business, and there's real value in that. That in itself makes investment a lot more personal. Today, I want to share a couple of these stories with you to remind you why we buy a company in the first place, but also to point out how stories are closer to fiction than fact and the reason why you shouldn't go it alone. This is where Momentum Securities comes in. You might have missed the recent roadshow where we discussed a particular interesting company. Although this company is not yet listed on the stock exchange, it does remind us that we have to look for opportunities outside of our borders and sometimes outside of what is comfortable. The first story starts with this very special animal, the dire wolf. Some of you might recognize this picture, at least those of you that were dedicated Game of Thrones viewers. They once roamed freely in the Americas, all the way from Venezuela right up north to Canada. But not a single one has been seen in over 10,000 years when this species went extinct. So, was this picture AI generated? Nope, this is actually the real thing. Let me tell you more. Relying on groundbreaking genetic engineering and ancient preserved DNA, colossal scientists have deciphered the dire wolf genome, rewritten the genetic code of the common grey wolf to match it, and using domestic dogs as surrogate mothers, brought back the dire wolf, effectively the first time de-extincting a line of beasts whose live gene pool vanished long ago. They basically used the grey wolf's DNA to fill the gaps in the DNA of the dire wolf. On the right-hand side are the first puppies that were born a year ago, Romulus and Remus. On the left was the third born a couple of months after the brothers, and she's called Khaleesi, after the Game of Thrones character. Here are some of the other projects that they are working on. Their next project is to produce a woolly mammoth. The company says it's on track for embryos to be ready for implantation by the end of 2026, to meet its goal of a calf being born in 2028. Then on to bringing back the Tasmanian tiger that was hunted to extinction. Is it starting to sound familiar? Like a Hollywood movie perhaps? Jurassic Park come to mind? Spoiler alert, it didn't end well for the humans. As entertaining as it will no doubt be to soon visit a real-life Jurassic Park, why are we even looking at this company? Colossal is a formidable business. Despite only being founded in 2021 with 130 employed scientists, it is already estimated to be worth around 180 billion rand. Colossal sees plenty of commercial potential in the cellular and genetic engineering technologies their scientist teams develop, which has uncounted amounts of applications. It can be used in the biomed domain, including treating and preventing diseases. Those genome engineering technologies alone are worth tens of billions of dollars. The point I want to make with this company is that if you don't actively look for opportunities, you will miss it. At Momentum Securities, we have the privilege to spend most of our day looking for opportunities on behalf of clients, something that is time-consuming and requires skill. Speaking of skill, and sticking to the biomed theme, another story I wanted to share with you is a company called Theranos. Once upon a time in Silicon Valley, a young Stanford dropout named Elizabeth Holmes had a vision. She wanted to transform healthcare by making blood tests faster, cheaper, and less painful. Instead of long needles and vials of blood, Holmes promised a single finger prick, just a few drops, and hundreds of tests run on a sleek, compact machine. She named the company Theranos, inspired by therapy and diagnosis. Holmes modelled herself after Steve Jobs. Black turtleneck, bold speeches, deep voice that conveyed authority. She sold not just a product, but a dream, democratizing healthcare and saving the lives through technologies. Investors, dazzled by her charisma, poured in hundreds of millions of dollars. Her board of directors was a who's who of American power. Former secretaries of state, defense, and even military generals. By her early 30s, Holmes was celebrated as the world's youngest self-made female billionaire, and Theranos was valued at $9 billion. But behind the curtain, the reality was different. The blood testing machines, the Edison devices, didn't work as promised. Instead of running hundreds of tests, they often struggled with even one. To keep up appearances, Theranos secretly used commercial machines from other companies to process samples. employees who questioned the science faced intimidation or were quickly silenced. The illusion held until a Wall Street Journal journalist began investigating. Through whistleblowers and leaked documents, the truth came out. The technology never worked. The fallout was swift and brutal. In 2018, Holmes and a partner, Sunny Balwani, were charged with fraud. Billions of investors' money evaporated. Walgreens, which had partnered with Theranos, shut down its testing centers. Patients who trusted the results were left questioning their diagnosis. And in 2022, Elizabeth Holmes was sentenced to over 11 years in prison for defrauding investors. The moral of the story? Theranos saga isn't just about a failed startup. It shows how storytelling can inspire, but also how unchecked hype can blind even the most seasoned investors and leaders. That transparency in business is a non-negotiable, especially in industries affecting human lives. And that even in the age of Silicon Valley disruption, science is not something you can fake it till you make it. Elizabeth Holmes set out to change the world. And in a way she did, but not how she intended. Instead, she gave us one of the most powerful cautionary tales in modern business and investment history. And again, the story tells you that you need someone on your team that can go and dig deeper to avoid investment traps, which is what we do. How many times don't we hear about vulnerable clients that lost their retirement savings when they bought into the story of exorbitant returns? Help clients avoid these traps by partnering with a professional that can dig deeper. This again speaks to the importance of your role in this partnership. A PSP is not created in isolation. It's the product of collaboration between the client, advisor, and portfolio manager. Clients bring their story, goals, anxieties, personal preferences, and ambitions. Advisors translate that story into a strategy, ensuring advice always meets context, ensuring that the correct structures are used to reach the outcome as part of the client's holistic plans. Portfolio managers deliver disciplined execution and market insight and guidance when things don't go as planned, whether that is in the markets or unplanned events in the client's life. This partnership ensures portfolios are both technically sound and deeply personal. Personalization is not just about today's returns. It extends into the future. A PSP integrates naturally with legacy planning, multi-generational needs, transparent wealth transfer, and continuity between today's objectives and tomorrow's inheritance. By being personal, the portfolio becomes part of the client's story. The industry is accelerating towards automation and commoditization. But efficiency without relevance, it's not advice, it's distribution. Clients can quickly just become a number and their story gets lost. A PSP proves that personalization is not a luxury. It is a necessity in a world of volatile markets, shifting regulations, and evolving client needs. It demonstrates that scale and individuality can coexist. In a marketplace of mass-produced products, the PSP is more than a name. It's a philosophy. Thank you for listening.
Thank you, Janine. It's clear how the personal share portfolio offering adds depth and individuality to our broader suite of wealth solutions, helping advisors deliver experiences that are as personalized as they are professional. Finally, to wrap up today's insights, we cross over to London to hear from Richard Stutley. He's a senior portfolio manager at Momentum Global Investment Management, or MGIM. Richard will unpack Trump versus the Fed, implications for global portfolios, exploring how political change, policy direction, and market sentiment are shaping investment positioning going into 2026. Richard, over to you.
Thanks very much, Teres. Okay, I wanted to start with just a brief reminder about the theme on this slide. In terms of the portfolio management team in London, you'll be familiar with myself and Jade there at the top. Jade comes back from maternity leave very soon. You may be less familiar with some of the other key individuals, however. So there at the bottom, Gregoire, Lorenzo, and Alex, who in fact heads that portfolio management team in London. And I make the point just because you should expect to see and hear more from these other guys in the coming quarters. Okay, on to markets. Here we go. This first slide. We remain in what I like to call an everything rally, all the lines rising to top right, which is what we want. You've got gold at the top there on this fantastic run. At the time that I now come to when I'm recording, gold's pulled back a little bit, but it's still had a fantastic year. So gold at the top. Next, emerging market equities. They've had a long period when they've not done as well as developed markets. They're doing well this year. Next, you've got developed market equities, and finally at the bottom there, you've got global government bonds. Nowhere near as much as those other asset classes, but still not bad. So it's been a good time to be invested. In terms of the picture, of course, we can see there, and you'll remember in April, tariff fears led to that sell-off. But then we had a really strong rebound in the latter part of Q2, and that continued, thankfully, in Q3. And that's because those tariff fears started to abate. The US very swiftly concluded deals with the likes of Japan, the EU, and entered into negotiations with China, which are still ongoing. Here then, what's been going on within specifically the equity markets? Well, in the first part of the year, up until April, it was equities outside of the US doing really well. Post-April, post so-called Liberation Day, it's then been the US, which has rebounded the strongest. It's been things like the Magnificent Seven. And on this next chart here, we just dig into a bit more detail. You see, it's really been those AI-linked big companies like your Nvidias, but also your Apples and your Alphabets that have been doing really well. And interesting to know, this is not just in the US. You've got the big Chinese tech leaders also doing well. As you can see there, Alibaba, Tencent. So that's been the area of markets that have really driven returns post-April. In terms of bond markets then, here focusing on government bonds, you'll have heard a lot about bond volatility, and there's great excitement whenever yields move up 5 basis points and then come down 5 basis points. The reality is, if you look at this chart going back over the last 18 months or so, yields have been pretty range bound. And this picture is absolutely fine. Why do I say that? I say that because at the top there, you've got your 10-year treasury still paying you of the order of 4% today. That's a decent yield that you're collecting. And alongside that, there's plenty of room for yields to go lower, the capital values, therefore, to go up. And what would do that? What would do that, of course, would be a negative economic outcome. So bonds are doing what you want. They're giving you that income, and they're there if you need a little bit of protection. That was government bonds. In terms of credit, here we're looking at credit spreads, and they've also been pretty well behaved. This is a long-term chart. What we're looking for here is any signs that credit spreads have started to go up. They did around April time. They subsequently came back. The fact that they've been pretty well behaved means, of course, that you've outperformed by holding credit over government bonds. So again, no problems as yet within the credit space looking backwards. And then finally, the dollar is always very topical. Of course, we had that sell-off, but that was very much focused on Q1 this year. Thereafter, you can in fact see that versus some of these currencies here, the euro, the yen, sterling, in fact, since April, the dollar's very much been moving sideways. So a question I often get is, what would it take for us to see another sharp leg down in the dollar, reminiscent of Q1? And per the title of this quarter's presentation, I think the big one is this, and that is that is President Trump versus the Fed and everything that he has been saying and tweeting. The US is exceptional. The dollar is a stable and reliable currency, but those two things are only true as long as the US has exceptional institutions, and that includes a strong and independent central bank. And I say that because of this chart here. This is looking at long-term inflation, and it's the case that central bank independence has certainly coincided with, if not been the cause of, this great period of stability we've had since the 1990s in terms of inflation. And yes, we've had a bad bout of inflation recently, but you can see in the context of what went before this period of central bank independence and inflation targeting, you can see that there was a lot more volatility historically. So central bank independence has worked, I would say. You lose that in America, and I think you're going to see more flows out of the dollar. How are economies doing? Yes, we're seeing a bit of a slowdown. That's not unexpected. That's the normal cyclical nature of economies. Here we're picking up that slowdown in the US housing markets. Then on this slide here, the same picture in the labor market. It's a slow or a gradual slowdown. But of course, I'd say these two things are okay. They're okay on the basis that we've still got short-term interest rates above 4%. That means there's plenty of ammunition for central banks to come and assist the economy by reducing interest rates. But key to that, and hence the key question that remains, is still, as shown here on this slide, it's still inflation. And we're not out of the woods. We're not out of the woods because of tariffs, certainly. And there's been a bit more of a flare-up in tariff-related chatter in recent weeks between the US and China, between the US and most recently Canada. So that's still the thing to watch. On this chart here, it's just pointing out that what's been really helping inflation, certainly headline inflation, is the decline in the oil price. So I'd say overall it's okay on the economic front, but let's not be complacent about inflation. How then are prices? Well, here, no real change in this picture. The US really stands out at the top there. Its equity market looks pretty expensive. Elsewhere, valuations are reasonable. How about bonds? Well, key to note that a lot is priced in terms of interest rate cuts. And yes, we may get some, but the bond market has already priced it in. You add those two things together and you've got big parts of markets in terms of US equities, in terms of US treasuries that aren't particularly cheap today. We've also had a great run. Add those things together, I think it's time to be a little bit cautious. And that's what we're doing in the portfolios. Not too cautious. I'm talking maybe an extra 5% cash. I'm not talking an extra 15% cash. And that's because outside of these kind of areas, we still find other investments that look pretty interesting to us. Okay, so here are the funds you'll be very familiar with: Momentum Global Cautious, Global Managed, and Global Growth. Here are long-term returns. In each instance, you want to compare the solid line against the dotted line of the same color. So at the top there, Momentum Global Growth doing exactly what it should do. Similarly, Momentum Global Managed, and as it has been for several quarters now. Momentum Global Cautious a little bit behind, but still very close to that reference rate. So doing pretty much what you'd expect, but it does need to catch up and overtake. In terms of the quarters, we move on here on the left-hand side, and I'll just start at the top. So Momentum Global Cautious does 2.9% in Q3. How does that compare against Global Cash plus 2.5% per annum? Well, it did the lower 0.7%, and then the peer group median also behind us did 2.6%. So Global Cautious outperforms both its target and the peer group median. Down to Momentum Global Managed, it does 4.4%. That compares favorably to Global Cash plus 4%, which only did 1.1%. And it's ahead as well of the peer median, which did 4.2%. And similar picture for Momentum Global Growth. It does 5% over the quarter. That's a really good return. We shouldn't always expect returns of that order of magnitude, but it is nice when it happens. That is ahead of Cash. That is also ahead of peers who did 4.6%. So a good outcome over the quarter. All the funds ahead of those reference rates. What drove that? Well, we'll look at here. If we look on the right-hand side, you'll see a small positive from asset allocation. You'll see in the next column that manager selection, that column is actually pointing down. So we gave back some returns by virtue of our managers underperforming. We'll look at what happened there in a moment. And so net on this chart, we end up a little bit behind. And the reference rate I'm using here is a classic 60-40 portfolio. So 60% equities, 40% bonds. How do we do against that? Well, our return of 4.4%, that was better than Cash. That was better than peers. But actually, as you can see here, we left a little bit of returns on the table. And that was virtue of manager selection, which I'm going to touch on in a second. So here's that picture on asset allocation. We make the right asset class calls. The biggest one therein was having a gold allocation. Gold, as you can see on the right-hand side, we have a mixture of physical gold and gold mining shares. Together, that allocation did 27% over the quarter. So an extraordinary quarter and this extraordinary run for gold. It will have a period when it comes back sharply. We consider it a long-term strategic exposure. So we're relaxed about that. It's a core defensive asset for us. And so you'd always expect the some gold in the portfolios. And it did really well for us, as you can see, in Q3. And as I say, what didn't work was manager selection. We picked out here one of the biggest detractors. That was Evenload, who's our global quality manager. We own them in the Momentum Global Equity Fund, which, remember, that's just a wrapper. Inside that wrapper are all of these world-class boutiques, Evenload being one of them. Evenload underperformed over the quarter because they simply didn't have enough of those AI-related stocks, which did really well. And in truth, very, very few active managers did. So we saw the majority of active managers underperform last quarter. This kind of an outcome over a very short-term period, 3 months, this does not worry us. We want Evenload to keep doing what they've been doing for years and years, and that will lead, we believe, to strong long-term returns, which is what we're more interested in. And then finally, we go back to the numbers and now concentrating on the minimum recommended holding periods for the three funds. So for Cautious, that's 3 years, and over 3 years, it's done 10.2% per annum, ahead of its cash target and ahead of peers. So a decent outcome. Momentum Global Managed over 5 years, 6.3% per annum, again ahead of its cash target and peers. And finally, Global Growth, 7%. That's in line with Global Cash plus 5.5% per annum. And it is slightly ahead of peers. So a decent set of numbers. Thank you for your time and the team, and I look forward to updating you next quarter.
Thank you, Richard, and thank you to all our presenters for sharing such valuable insights today. We've seen once again how powerful advice becomes when supported by the right solutions, and how our MFP flagship fund range is designed to help you deliver those outcomes. Here's to finishing 2025 strong and to another year of smart, client-focused advice in 2026. Thank you all for joining us today. It's been a pleasure to share this time with you.